Have you ever made the mistake of conflating volatility and risk? If so, you've probably ended up losing some large chunks of money when you made that mistake. I've done that plenty of times myself before I finally learned the lesson. Conflating these two is something that I think is one of the biggest mistakes that the traditional financial industry falls into. You can see this happening all the time, whether you log on to your 401k and it tells you, hey, this is how much you can expect to have at this age, whether it's a bull market or a bear market, maximum, minimum, based on the risk associated with your portfolio. You look at a mutual fund or an ETF and it'll tell you on the rating, hey, here's the risk associated with this fund. You call up your financial advisor and you say, hey, I'm getting older. I would like lower risk in my portfolio. And they say, okay, we're going to put you in investments that have lower volatility. All of these three things that I've just described are confusing volatility with risk. The reason for this, number one, is because volatility is very easy to measure and risk is not. But that's not an excuse. Just because something is easier to measure doesn't mean you can just swap it out and call it the same thing. Volatility and risk are two very different things and many times actually opposites, which means that investors going for something that's called low risk but is actually low volatility, they're actually investing in something that is high risk. Here's the real definition of volatility. Volatility is the amount that an asset price moves up or down. That's it. So what is the difference between these two? Well, volatility on one hand is just the amount that something will move up and down percentage-wise. And so if some price of something moves up and down quite a bit, that's considered volatile. And most professional, traditional financial advisors and people in the industry will tell you that's high risk. It's actually not. Risk is the chance of you losing money on your investment, losing some or all of your investment. Now, on the surface, these two things might look very similar, but when you flip them upside down, you realize how different they are. Because if you assume that volatility and risk are the exact same thing, then you would assume that something that is low volatility is low risk. Now, a fantastic example of one of the lowest volatility investments in recent history is the US dollar when it was pegged to gold, because 35 US dollars were redeemable for an ounce of gold. Of course, not for individuals like you and me for a long time. For many decades, that was just for central banks and other countries and large institutions. But you get the point. 35 US dollars was worth 1 ounce of gold, and the amount didn't change. There was zero volatility, therefore it should have had zero risk. However, that lack of volatility was there to mask the risk that was there. It was an artificial price imposed regardless of what the actual value was underneath that mask of low volatility. There was a massive amount of risk there and it just wasn't able to be seen by anybody because of that mask of low volatility that was enforced on it. And then at the end of the day, as always happens, when those pegs can't hold, it breaks and the value of those dollars plummets. And instead of needing only $35 to get an ounce of gold, you suddenly need hundreds of dollars to get an ounce of gold. Was there a risk there of losing some or all of your purchasing power? Absolutely. Was it volatile? Not at all. Now let's take for another example on the opposite side of the spectrum, something like Bitcoin. Extremely volatile, right? Does that mean it is high risk? Not from the volatility alone. In fact, the volatility specifically in Bitcoin is there because it is such a free market, such a low regulation market where people can buy and sell extremely freely. And when you have buyers and sellers and potential buyers and potential sellers all able to move in and out extremely quickly, slowly, or with large amounts of money at a time, then you come up with your equilibrium, your asset price, your consensus value on the asset very easily. Contrast this with something like the stock market, where if it sells off too fast and too severely, then they'll just shut it down and you won't be able to trade until the next day. These circuit breakers don't exist for things like Bitcoin, and so if everybody starts selling, that price just keeps on dropping. This makes for assets that are extremely volatile, but what they're doing is reflecting the real value that's actually there. Now, you may disagree with what the future value of that asset may be, but the higher the volatility shows, the freer the market, and the freer the market, the more the consensus can be expressed in the price. So while volatility can certainly present a risk that you may lose some of your investment, such as if the price drops from the asset being volatile and you're forced to sell from a margin call or just because you have to sell for funding some of your expenses, that doesn't mean that they're the same thing. And many times a lack of volatility can cover up the real risk that's actually there. And finally, if you would like more of this and how to use this and apply it to your overall investing portfolio, check out my portfolio allocation mastery course linked in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.